Last year, this time, we published a somewhat divisive white paper outlining why we thought it was finally time that Canadian equities could outperform their US peers. Well, it may be un-Canadian to brag, but now it's safe to say that Canada may have finally gotten its groove back, and our confidence is even greater now relative to that 2021 call that this year, 2022, will be another year of outperformance for Canadian equities. Prior to last year, the S&P 500 had outperformed the TSX in 9 out of the prior 10 years. During that stretch, the TSX had risen a respectable 115%, but that return was completely overshadowed by a monstrous tripling of the S&P 500 over that time. To be fair, 2021 was a little bit of a push. The S&P TSX did outperform the Dow Jones Industrial Average, the NASDAQ, and the Russell 2000, but it fell a tiny bit short of the S&P 500 on a total return basis. But the arguments we presented last year are much stronger and more supportive today. Last year, this time, we noticed a decidedly wide deviation between the forward price to earnings ratio of the TSX and the S&P 500. The TSX was slightly more expensive than its 20-year average of about 16.2 times forward earnings, while the S&P 500 was trading about 5 multiple turns higher than its long-term average of 16.7 times. Today, there is a similar 5 multiple gap between the S&P 500 and the TSX, except today, the TSX is close to 1 standard deviation below its long-term average, while the S&P 500 still looks expensive at 20 times forward PE. The second main point in our argument was composition of the indices. The S&P 500 is dominated by technology companies and technology-like companies such as Meta, Amazon, and Google. The FANGMA stocks, as they're essentially known, have powered the past 10 years of growth for the S&P 500. But the law of large numbers and the prospects of rising interest rates may make the prior impressive run difficult to sustain. We've already seen some of those pillars start to crack, with the likes of Facebook and Tesla experiencing 30% drawdowns. Conversely, the TSX is much more cyclically balanced with its 3 main pillars, financials, energy, and materials, benefiting from rising interest rates and the economic growth we're expecting post the COVID recovery. One of those sectors, energy, has already had an impressive rebound off of its 2020 lows, and we've seen oil surge higher in recent weeks. However, there are many reasons to believe in the sustainability of this energy bull run. Over the past year, we've seen global inventory levels being drawn down. DUCs, or drilled and uncompleted wells as they're called, are a leading indicator, and they've fallen to cyclical lows, all while producers remain quite disciplined on their production growth, even while demand begins to approach pre-COVID highs. More specifically, the Canadian energy producers have already repaired their balance sheets, are generating record free cash, and returning that cash to shareholders, yet still trade close to trough valuations. And while some people criticize the carbon footprint of oil producers, it is important to point out that our Canadian producers are amongst the least carbon intensive and most ESG conscious producers in the world. As well, providing balance to the energy sector is the relatively high 3% allocation to the renewable companies on the TSX that should benefit from the next few decades of renewable growth. Rounding out some of the tailwinds Canada has over the US in a post-COVID world is our thoughtfulness through COVID. Our population has a much greater vaccination rate, a much lower death rate, and that's contributed to the strong rebound in employment. Canada has recovered more than all of its lost jobs during the pandemic and has seen its participation rate get back above 65%, while the US lags a few percentage points behind. But really, one of Canada's superpowers is its strong immigration policy that will target over 400,000 new Canadians, or more than a 1% boost to its population. The highly skilled and educated new Canadians give a boost to growth and stimulate the overall economy, making up for the lackluster birth rates problematic in many developed countries. All of the tailwinds just mentioned, plus the higher expected earnings per share growth for the TSX due to its cyclical growth composition, plus the much lower starting valuation, positions the TSX extremely well to outperform US equities in 2022. Now, this won't be the case every year, so let's enjoy it while it lasts. Go Canada!